In 1720, the streets of London were not paved with gold, they were paved with paper, stock certificates, promises, and lies. This is the story of the South Sea Company, a firm that promised vast riches from gold mines that didn't exist and trade routes they couldn't access. It was a Ponzi scheme built on national debt, leveraging the greed of an entire nation, from the richest duke to the poorest street sweeper. The stock rose from £100 to £1,000 in 6 months. Then, it became the greatest financial collapse in history. Fortunes were wiped out, politicians were exposed as thieves, and the world learned a terrible, bloody lesson about the true price of speculative mania. This is the story of the South Sea Bubble. The year is 1711. Great Britain is drowning in debt. The nation's coffers were exhausted by decades of relentless European wars, leaving the government holding a crippling national debt of over £30 million. This was an astronomical sum, and Parliament had no idea how to manage it. The entire financial stability of the kingdom was under threat. Into this crisis stepped a seemingly legitimate, but fundamentally bankrupt, solution: the South Sea Company. The company was founded by Robert Harley, who proposed an audacious trade. In exchange for assuming a large portion of the national debt, the company would receive a monopoly on trade with the lucrative, but largely imaginary, markets of Spanish South America. This was the promise. The reality was a fragile piece of diplomatic maneuvering known as the Asiento Contract. This contract, secured through the recent Treaty of Utrecht, gave the British only a limited, highly regulated access to the slave trade in Spanish colonies, and virtually zero access to the gold, silver, and spices the public dreamed of. The company was built on a lie, a glorious, glittering fiction that masked its true, grim foundation. The real plan had nothing to do with South America. The plan was a financial shell game. In 1719, the South Sea Company proposed an aggressive deal to Parliament. They would take over the majority of the national debt. In exchange, the government would pay the company interest, and the debt holders, thousands of British citizens, would be encouraged to exchange their low-yielding government bonds for shares in the glorious, future-rich South Sea Company. This debt-for-equity swap was the engine of the bubble. By absorbing the government's liability, the company acquired an aura of state legitimacy. The directors, now working closely with the Chancellor of the Exchequer, began leaking sensational, fabricated stories about the vast fortunes being brought back from the Americas. They hired agents, often called scouts or lighters, who were paid handsomely to frequent coffee houses and stock exchanges, aggressively whispering rumors about imminent gold shipments and guaranteed dividends. This was the first systematic use of financial propaganda to pump a stock price. The public, tired of the austerity of war and promised instant riches, began to believe the fiction. By the spring of 1720, London had spiraled into total speculative mania. Change Alley, the unofficial stock exchange, was so crowded with shouting, desperate investors that traffic was gridlocked for hours. The South Sea stock price, which had hovered at £128 in January, surged past £300 in March, then £500 by May, and peaked at nearly £1,050 in June. Everyone, from wealthy dukes and duchesses to servants and milkmaids, was investing their entire savings, often mortgaging their houses or selling their family's silver to get in on the action. The frenzy was so extreme that it birthed dozens of rival, absurd bubble companies. Entrepreneurs, sensing the public's blind thirst for any promise, created firms with names like a company for a wheel of perpetual motion, a company for making salt water fresh, and most famously, a company for carrying out an undertaking of great advantage, but nobody to know what it is. even though many of these rival companies were obvious farces. The public continued to pour their money in, believing the bubble would never burst. This phenomenon proved that when financial mania takes hold, the demand for quick profits overrides all logic. The directors of the South Sea Company realized that the success of their scheme depended entirely on eliminating the competition. In June 1720, they pushed the government to pass the Bubble Act, a sweeping piece of legislation designed to shut down all rival, unlicensed speculative companies. The Bubble Act was meant to secure the South Sea monopoly, but it achieved the opposite. By killing off the competition, the company inadvertently popped the entire speculative enthusiasm that had been floating the market. Panic set in. Investors, who had relied on taking profits from one bubble company to reinvest in another, suddenly had nowhere to go. They began to question the foundational asset of the South Sea Company itself. The stock began to bleed, slowly at first, but then catastrophically. By September, the stock had plummeted back down to £150. The entire financial structure of Britain collapsed in weeks. The fallout was devastating. Thousands of families were financially ruined, committing suicide in despair. The public discovered that the promised riches from South America were a fiction, and the political establishment was completely implicated. The Chancellor of the Exchequer, John Illaby, was found to have taken massive bribes. The lesson was brutal and remains eternal: when the entire market believes in a glorious fantasy built on debt, it only takes one pen, or one inconvenient law, to prove that paper is, indeed, just paper.